at the conference, if I see that the whole idea of this conference is to connect the investment ideas with the capital, and most of the investors who have experienced huge volatility in last few weeks have, I think, got the decent chance to re-enter into the market, those who were feeling the left out. And my interaction with some of the domestic investors as well as the foreign investors suggests a few strong points in favor of India. They are saying that India is at a sweet spot in terms of geopolitics. The inflation trajectory is downwards. RBI has cut the interest rate, and if the inflation trajectory is favorable, then we can see more accommodative stance from the RBI. While the GDP growth on an absolute basis is slightly slowed down, but if we compare it with the leading economies in the world, we are still doing the best or better. So from that perspective, they believe it's a good place to continue to invest, and at some point in time they would like to increase the allocation, and on a select sector they have already identified and making those bets.
And what are the sectors that you and the people at your conference are optimistic about right now?
So, if we look at, while it is the most popular theme in the market, and some might say that there is a lot of run-up which has happened, but as a theme I have seen people continue to talk about defense, and not only in India, they are talking about globally. So it's not a new theme, but I would say this as a theme which continues. In terms of pharma, what I have heard that people are saying that this is one of the sectors which cannot be ignored for a very long time in India. Again, India is making good strides in the manufacturing sector. So people are very positive about manufacturing in India. Now, everybody has talked about, say, China plus one. People are also talking about that why not India can be a place where it can act as like China plus one, Vietnam plus one. So I think there is a lot of bullishness on the manufacturing sector as well.
We've seen a momentum in the local equity markets, which is building up now. There are bouts of volatility we've seen. I mean, the market is down today, but I mean, this is something which the market has picked up momentum from the time from early April when the US announced tariffs, and there was a bloodbath in the global markets. So going forward, what's your outlook on this space of the market building up from here?
I think earnings now have bottomed out. I mean, last 2-3 quarters we were seeing a trend where earnings were kind of declining. This quarter so far, whatever results have come, I am slightly positively surprised with the growth in the top line as well as in the bottom line. So in my sense, from here on, the earnings can either remain stable or start improving. I think we have kind of estimated, how the tariff angle is panning out, and more or less, unless again a big surprise comes, we have started factoring in that what kind of slowdown it can bring into the various sectors and what could be the quantification of it. So from here, I am not really very negative on the markets. I think market will still absorb some of the recent developments in terms of geopolitical developments or balance earnings, remaining earnings which are yet to be announced. So from that perspective, I think the kind of dips which we saw twice in the beginning of this calendar year gave good entry points to the investors, and from here on they can start building up the momentum, or at least keep the momentum stable.
Right. Now coming to industries in India, we did see a lot of concern in early April when the US imposed tariffs on all its imports. Given the fact that now India has agreed to a trade deal, an FTA with the United Kingdom, and we are on course to concluding a trade deal with the United States now. For sectors, how does that augur? How is that a factor that would improve earnings going ahead, and will this provide comfort, more cushion to the local markets, equity markets?
India, UK, FTA, the details are yet to be worked out. So while the initial feelers are available that which sectors could be favorably impacted or which sectors could be negatively impacted, rather jumping to the conclusion at this moment, I think let us see how all these details get worked out. US, I think with respect to the tariff, our representatives have done a decent job, and it's at the moment a work in progress. More or less, what we have come to the conclusion that a 10% universal tariff is going to stay here, and as and when any differential tariff comes up, you will have to start factoring in that well. So, and I have always held this calculation in mind that the impact of overall US-India tariff may not dent GDP more than 0.3 to 0.5%. So yes, a sentiment-based correction and volatility could emerge, in the market across the sectors. But from here on, I would tend to assume that the earnings and the prospects of the businesses will take over, and more or less the discussion on the tariff and other things should start taking back seat now, unless you have something coming very drastically, or somebody announces something which is very unexpected.
Yeah, and you feel that these trade deals would be favorable to Indian exports, especially to India INC that is exporting goods and services globally?
I frankly need to look at more details into that before commenting.
All right. Okay. Coming to our economy. Okay, we have seen growth is still below what RBI or what the government would want it to be, but at the same time we've had a very comfortable inflation. The RBI has started cutting rates this year. There is been a good deal of liquidity infusion through CRR cut, and also through OMOs, through dollar-rupee swaps and all. So, how do you see this impacting economic growth? Would these be factors, especially the liquidity infusion? Would this help boost credit for corporates, and would this in turn help build an economic upturn?
So I think you are right in saying that yes, there is some deceleration in the GDP growth. So we are not where we wanted to be, and definitely we should not be happy with this kind of growth number. We should aspire for higher number and better numbers. On a relative basis, we are definitely doing fine. And in the recent MPC meeting, if you see, RBI also changed its stance to accommodative. That means they clearly feel that inflation is more or less under control, and it's kind of below their threshold of 4%. And now it is time to focus on the growth of the economy, and that's why they have started taking those measures. So in a combined manner, the measures which are taken by the central bank is definitely going to help in boosting the Indian economy.
And what does that mean for rupee bonds? I mean, do you see the potential for a bond rally? Do you find bonds currently still undervalued, and there is still juice left for them to rally further?
Tough to answer right now, because if you see, a good amount of rally had already happened. I think, and it happened rapidly. I think we were somewhere at around 7.2, 7.25. And from there we have traveled all the way to 6.5, 6.6. So it's a good rally which has already happened. I am not expecting that this kind of sudden rally will happen in the bond again in such a short span of time.
Right.
But the overall trajectory is favorable. The way the inflation numbers are panning out, the way the reserves are built up, the way your currency is behaving, the way your economic growth is panning out. So it's still favorable, but I'm not seeing that that it will move with that same velocity.
And your forecast on RBI rate cuts going ahead?
I mean, tough to forecast. As a house, we are of the view that another 25 to 50 bips can yet happen in this calendar year. Yeah. Yes. It can yet happen. Yeah. The timing is yet to be seen, because globally your inflation numbers are not as under control as India's inflation numbers are, and global treasury yields are not as soft as India's treasury yield. So domestic factors are allowing RBI to to cut the rates. So unless there is some external challenges, as a house we are of the view that yes, 25 to 50 basis points room you still have in the fiscal year. Yeah.
Okay. And in this phase of volatility, globally there is a lot of uncertainty which is still there. What is your house view about foreign investor, institutional or maybe retail? What asset classes would you be optimistic that can help investors hedge their positions in a volatile time like this?
So we are an equity house, so our views will be centered around the equities. We keep coming up with the views that are the times cautious or are the times more aggressive, or moving towards the aggressive. We turned cautious somewhere around October, November last year, and we again turned bullish sometime March, April this year. So as an equity house, we keep giving these kind of views, that what are our views on the markets, whether we are turning bullish or turning cautious. Personally, I feel that and you talked about gold some time back. I always feel that it's a good asset class to have in the portfolio. At your comfort, 5%, 10% of the portfolio. And you also talked about the volatility. So in the volatile times, I always believe that 10-20% of cash position doesn't really harm you, because you don't want to have a feeling of being left out if some sharp swing comes into the market, and remain systematic about your investment. So I think that's the approach one can take in these kind of markets.
Gold has touched an all-time high last month. It's hovering around there. What's your view on the yellow metal? You think it's peaked, or probably there is scope for the yellow metal to gain further? I mean, we can see a correction over there.
So I don't see gold from the perspective of that can it give me a certain percentage of return in next 6 months or 1 year. When I was talking about gold, it was somewhere around 85,000 per tola. Now I think it is 1 lakh or beyond 1 lakh. At that point in time, we didn't know that it would appreciate so fast in such a short span of time. Couple of factors led that kind of return in gold. I think that for you to be an investor in that asset class, you have to play the full cycle, and that full cycle could be a 5-7 year cycle. So, and at point in time, you will feel that for 2-3 years it is silent and not giving any return, or it's giving negative return. And in a cycle like this, it will surprise you, and it can give you a return which you would have received in last 4-5 years. That's the way you need to treat the gold, have it in part of your portfolio, and it will give you surprises on both the sides, but at least also give some peace of the mind that I have an asset class in my portfolio which is a hedge against the volatility, the inflation, the external shocks and all.